Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, December 20th, and it is our final webinar of the year. Great to be with you guys this morning. Iman, Jaya, Kamal, Mike is in the house, Michael's in the house, Tom's, great to see everyone here. Wish everyone in the room a very happy holidays, a Merry Christmas, and an awesome new year. Lots to discuss today on the back of yesterday's interest rate decision. We got the 25 basis points as expected. We got the shift in the interest rate dot plot as expected, and the dollar turned over, okay, which was hoped. Let's not say expected, but it's finally working out. So we'll hit the DXY, Euro, Kiwi. Interestingly enough, Euro Kiwi super clean over the course of the week. We'll hit dollar CAD, Aussie dollar with a drop yesterday. It came off the low day close. I know Jamie's still looking lower. I don't really have a very strong opinion about it, but we'll look. Kiwi yen, Aussie yen, and Euro yen. The only yen crosses that have been of interest for me have been outside the dollar. So Euro yen, Aussie yen's kind of a little messy right now, but Euro yen and Kiwi yen have been pretty clean. We'll circle back and talk about gold. I don't have much to talk about crude. I just want to go with the big picture. I think we do look for support at these levels right here. So we'll take a look at that before we close out the year. And as always, guys, especially with today being the last one for 2018, feel free to throw out any questions, trade setups you want to review into the end of the week. Next webinar is scheduled for the 3rd of January. We'll still be giving you updates intermittently throughout the course of the month. So definitely, maybe not around Christmas and Christmas Day, but after Christmas and before New Year's, we'll definitely keep you up to date with what's going on in the markets. Look, hey, Eman, Michael, good morning to you. Happy holidays to you, sir. Eman, thank you for that. Look, with regards to the FOMC, man, you can hear interpretations, and I don't want to get too sidetracked with all the fundamental discussion, but you could get sidetracked, guys, and look, just over the financial news publications, and they're all over the place. There are people who are saying this was the most dovish Fed hike in years. There are people saying this is them saying that the markets are on not stable footing. Some saying that they're bucking, what the models should say and just going with what the White House say. All kinds of stuff. Let's just stay focused on what Price is saying and what actually happened. The basics, not my opinion, not Mike Boutros or Jamie Setley or SB or anyone. Facts. What they said lowered their growth projections for 2019 from 2.5% to 2.3%. So softer growth. Unemployment rate seen steady hold at 3.5%, nothing there. PCE inflation, okay, personal consumption expenditure dropped from 2.0 to 1.9, slightly softer. Core PCE, the Fed's preferred gauge of inflation, dropped from 2.1 to 2.0. So on whole, they've softened their growth and inflation expectations slightly. Okay, slightly. You move down to the dot plot. I provided that for you on Twitter yesterday. What am I looking for? Okay, and here's what it looked like. So the distribution for the dot plot 2019 slightly moves down, not by much. But you can see here the consensus cluster was a little bit above 3%. You had 8 Fed members in the 3.0 to 3.5% range. You've seen that lowered, okay? A little bit lower down. More importantly, also, you've seen the terminal or flat running, longer run inflation rate. Again, you had a pretty much stronger consensus here, 6 members at 3%. That softens a little bit down as well. So their overall targeting for interest rates moved down, and they're softer, and their distribution for next year's expectations for 2019 also softened. Call it dovish, call it a dovish hike, call it whatever the heck you want. It doesn't matter to me. The dollar did and responded accordingly as we had hoped. Here's the DXY. You all know this chart. You've seen it. You've lived by it, and if you have, you've been doing okay. That slope resistance failing to close above. Again, last week we closed just a hair above, but again, there was no consensus break here. Ongoing divergence in momentum. Here's the turn. Okay, here's the turn. I thought it was Yellen in disguise, Tobin Keynesian, says Ty. They never move in big increments. And that's the one thing I'll say on a side note as well, Ty, with regards to that comment. You know, there's a lot of people out there, even guys on the desk in New York and some of the trade desks that I have friends with. We were talking, and some of them were like, "Oh, you know, he didn't need to do this. He didn't need to do this, and he didn't need to hike rates. They didn't, you know, they should have moved interest rate dot plot much lower in regards, or in response, I should say, to the market turnover that we've seen. You know, we're almost 20% off the high in some of these equity markets. The answer is this, right in line with what you were saying, Ty. For the Fed to come out, remember, prior to this release, they were talking about 3 to 4 hikes next year, right? They're not going to move from 3 to 4 hike expectation down to 1. That would signal to the market that, yeah, there's something up. And that's the response that kind of they would want to keep on the side. So honestly, again, my humble opinion, I don't think we'll get 3 hikes or even 2 hikes next year. I think we get 1, if that. But they're not going to go ahead and say drop from a 3 hike expectation to, okay, we're going to go to 1. They're going to do it step at a time. So yeah, I do think that ultimately we'll get a more dovish outcome. But from the Fed's commentary and from Powell's demeanor and his speech, it's basically right in line with our thought process. So that's just a side note there. I agree with you. They have to take baby steps. You know, everyone's talking about Fed credibility and all this. Guys, the Fed's been wrong on inflation. The Fed's been wrong on growth. And the Fed's been wrong on interest rate expectations for the last like 7 years, basically. So this whole nominal notion that the Fed has this sort of big picture thing that they're responding to data, they are moving with the markets just like participants are all throughout the economy. So I'll leave that as it is. But good comments there. Iman saying responded perfectly to levels that you keep highlighting, Michael. You are so good. Again, I appreciate that, Iman. It's not my levels, it's the market's levels. I'm just helping you find them. So you all know this chart. If you need to take a snapshot, feel free. It's the same chart that was presented on the pre-FOMC update. Okay, this is the level of weekly resistance on a weekly close, monthly close. That's all that matters. Okay, is staying below that line. Now, we're not out of the woods yet. The big level that we're looking for as far as a support break would be 95.80s, 95.85. You're looking at the long 200-week running moving average. Basic trend line support off the yearly lows. You know, some of you look at this and you might be like, well, Mike, why aren't you taking sort of this slope? This slope might actually come into play. But for now, I like to use the extremes, the low. This is the major low. After the upswing, this was the next major low. Intermittent, you know, I'm not going to worry with that. Not only that, but the parallel, once we extended it off that high that we made in late May, has been perfect resistance. So that's still the level we need to break as support. Keep in mind, it's also the 38.2 line of the broader pitchfork of the decline from the 2015-2017 highs. There's that support bounce, support bounce, support. A little bit messy, but once we broke acceleration, resistance, break, that's the support that we would need to clear to suggest a bigger turn happened. Until that happens, we don't know. We know that we rebounded off resistance. We know that we got it off decent momentum. We know that everything looks good, but that's the break that would shift the technical focus lower. When I read the charts, it's stretched, but nothing changed, correct? What do you mean, Ty? Yeah, as far as this chart, man, nothing's changed. In fact, it's been a little bit clearer, Ty. We got a little bit stronger of a rejection. Last 3 weeks, we've been sitting there at that line. I didn't know what to do. You can't buy into resistance. I couldn't just sell blindly. But what happened yesterday and what we suggested and what we were looking for is, you know, as I said in the update previous, guys, the ideal scenario was to see the dollar sort of rip and then, you know, make a terminal thrust and then turn over. And that's basically what we're getting. So the daily chart, I think this is what you're talking about, Ty. Yes, range bound and the range is intact. The monthly opening range is what we're focused on. Here's DXY. Well, let me take that back. We broke the monthly opening range. This is the first sort of level of interest. 96.23 is a basic 38.2 of the September advance. There's that 95.77. Remember on the daily chart, on the weekly chart, we just look at 95.80. Guess what? You also have the 100-day moving average there in coordinate in the same level as the 200-week moving average that we just looked at here, right? And then a basic 50 of the advance, and again, that slope for the ascending pitchfork off last year and this year's low, right? There's that 50 line. So that's the next downside target. The range bound action that you're talking about, I think, is being challenged right here. So Ty, we've been looking at this as sort of consolidation. Remember, before this low, we were working with that. Kind of bounced off it last week. We opened it up a little bit, give ourselves some room. You know, I like this lower. So we're actually looking to validate this triangle break to the downside. To do that, we need 96.23. Remember, that's the level that we've been looking at since the start of the week. That's the level that needs to break. Here's the intraday targets we were looking at from earlier in the week. 96.14, nice confluence region, but here's the big level of support, 96.15 into 96.22. That's where we're sitting right now. Okay, here's the 240-minute of DXY as it stands. So no change to any of the levels. So I would argue, Ty, yeah, let me say this. We haven't validated a break of the range, Ty, but I'm targeting a break of the range. Let's just say that. Just as a disclaimer, I'm still holding a long euro from yesterday. So I want to see this 96.22 break. I don't know if we'll get it this week, but the ideal scenario is that this triangle consolidation with a failed break of the upside exhaustion, we need to see a break below this level to validate the move lower. Does that make sense? Objectively, we have broken the monthly opening range. Here's your December open. You set a low, you test the low, you test the break of the high, it fails that last month's range highs essentially. Here's the turn lower. Here's the break of the December opening range low. If this is legit, we want to see failure ahead of that slope. So let's say here, okay, like 96.50s, 96.55. A downside break from here, you're looking for that 95.68, 95.75 target right here. I got to adjust that 100-day moving average. Bear with me. There's the 100 now. Okay, we could probably drop this at this point, the 764 retracement. Go ahead and scratch that. Sort of the new amended targets here for the DXY decline. Now, remember, ideally, we get some downslope to give us some guidance here. I was checking this out yesterday. There's really nothing there yet, in my opinion, at least, that we can rely too heavily on. This median line, I looked at this last night. It converged on that lower parallel for the triangle consolidation. I didn't want to clutter up the chart and post this, but even more, right? Even more fuel on the fire, Ty, of why if this is a legit break, we should be looking, price should start to fail somewhere around here. And again, the downside, you got the 50 level, you got the lower parallels kind of converging on these levels that we've been looking at. So 100-day moving average just below 96, 50% retracement, former swing lows. Nice pivot there, 95.68, 95.75. Let's do this. Whoops. I'm sorry, guys. Hold on one sec. That's what I was trying to do. There you go. All right, so the level's pretty clean. We need some follow through, and we need to see the follow through happen on a weekly close basis to really validate it. So if you're not holding anything short right now, there's nothing to do here. You're at the range lows. If we see failure again here in early US trade into 96.60s, let's say, that's what we'd need to hold if this immediate stretch has downside play. Downside targets, again, pretty well defined here. That's DXY. So what does this mean for euro? Here's euro dollar. Well, let's just go back to the euro chart. No surprise that the inverse of this looks quite similar to the euro. Euro was coming off its own major support target. We've been talking about 113 for weeks and weeks and weeks. Former swing highs from November back here in 2016. Pivot break in 2017. Swing lows in August of this year. And obviously on a closed basis, it's been rock solid, right? You also have the long 200-week moving average similar to the DXY for the euro right there as well. You can't make this stuff up. It took a while. It pressed our patience. We doubted ourselves a couple of times. We might have got stopped out a couple of times, but boy, that's the spot. And we've getting the reaction. Again, we don't have validation. Okay, it's not full gung ho yet, but it's a start. 113 still the line in the sand. Topside resistance is the outside reversal week for the high September tick, and that is 116. That converges on basic slope resistance from the yearly highs, from the March highs, not from the yearly highs. Okay, so the weekly chart really clean on a downside break. In the scenario that this thing collapses below 113, you still have 111.86. That's this key 618 of the advance off the 2017 lows. So all things held constant, like it, want to see this thing higher. Again, not an area to chase because you've already made the rebound, but back in fill, we're looking to fade weakness. Here's Euro on the daily charts. And here's what we looked like pre-FOMC. Okay, consolidation, just like we were looking at DXY. Here's the consolidation multi-month from November lows in Euro. We talked about 1426. That's the level we needed to see break to give us the upside play in Euro. That's the 618 extension from the advance off the lows. It also converged on basic slope resistance. So that's the level we needed to see break. On initial breach, you're looking for the 100-day moving average, and you're looking for the 100% extension, which converges on slope near 115.24. So we're getting the tag of the 100-day moving average, the first target. Wouldn't be surprised to see some Euro weakness into the start of the U.S. trade session, but we want to see stabilization above 1426. This, my friends, is the important thing to note heading into the close of the week. This is what matters for the Euro. If this is going to be sort of a huge failure and this thing's going to turn around, momentum on daily basis is heading up into 60. This is where it would fail, and then we would see price duck back below. If it happens and we get a material close below 1426 and DX and momentum pulls back, that's a false break scenario. Not my favorite scenario, but I'm just prefacing this because we're not going to talk for a couple of days. So I want to make sure you guys all have your sort of what if scenarios all in play. I need and I want to see this thing close above 1426. I'm stopped at break even on the rest of it, but I am still holding some. I want to get that stretch higher. So that's Euro on the daily chart. Intraday. So again, no change to any of those levels, right? Intraday, right before the release, here's what the Euro looked like on the intraday charts. And the focus here was, what we had said is if this immediate advance has legs, we want failure ahead of 1336. Okay, didn't even get that low. Here's Euro on the intraday. Okay, pull back. So the levels have been adjusted just a bit. This retracement that we were looking at here, guys, has been taken to the new high. But the pullback leveled out right at monthly open support to the tick. Here's FOMC. This is where I got in. I got in and stopped just below 1350, and then this thing ripped. So we're at break even. I took a little bit off at 1472. I didn't even make it to the 100-day moving average, but this is the big level I'm looking for. Okay, the 100% extensions at 1524. That's the one that's on the daily chart, but you also have the 50% retracement of the entire advance of the September decline, rather, right? And that comes in right around there. Slope. Remember this pitchfork? I was saying I don't really know if it's too we don't know the efficacy of it yet. Don't put too much emphasis on it, but as long as we stay above the median line, basically, here is your new near-term bullish inval. I'll just get rid of that. 114. Okay, and 115.24. That's the big level. I need to see what's going to happen there. Now, if you see that break, I do think there's free 50 pips right here. 618 of the entire decline is 1586. But right now, this is kind of the biggest. What's the word? The biggest hurdle, okay, for near-term price action on the Euro advance. Finally, this thing. Again, it is a break objectively. Ty, we were talking about the DXY earlier. It's an objective break of the monthly opening range in Euro, but we haven't gotten a daily close yet, and that's what I want to see today. Okay, that's what I want to see today. Any questions on Euro? Here's what it looks like on the 120 minute. On the 120 minute. Okay, and here's on the 60. Okay, that is number 2. 1, 2, and let's hit Kiwi and then the Euro Kiwi cross that we covered yesterday. So Kiwi, I don't have anything on this right now as far as exposure is concerned, but um, it is coming into an interesting area of support. So last night, I wanted to highlight this cluster region just below the 38.2. I thought you were going to get a decent opportunity to get a rebound there to get back in on this one, but it kind of crashed through last night. So look, the big level to the downside still 67, 66.99, 66.96 to the 50% at the lower parallel. This newly added pitchfork that I showed you guys last night, that lower parallel converges on that region just lower. Here's Kiwi now. It broke the downside, but it didn't get the extension to 67. This is what kind of has me scratching my head with this right now. Look, if the breakdown is legit and you're still going to get 67 on this stretch, the weekly open is initial resistance. Bearish invalidation is just where I told you last night. It's still up here. So from a trading standpoint, I don't really have an entry to try to attack this. I do want to see 67 on the downside. I want to look for a reaction there. If we're going to get a rebound, that would be the spot. Remember where we are on Kiwi. Here's the daily chart, right? We came off a big level of resistance, parallel resistance, the 50% of the yearly range. There was so much up there. Here's the pullback. The median line break wasn't all that clean, but look what's down here at 67. You got the lower parallel, just 50 pips lower or so, not even 30 pips lower. You got the 100-day moving average, former swing highs from back here in September. Just a nice spot. So it's a tricky one here. If you're holding shorts, I would say if you're holding anything from northbound of 68.30, put a stop against this high and kind of let it play out and see if we can't get that 67 tag. If you're looking for new exposure, it's one of two things that may tempt a move for me. If we get a rally and failure here at the 200-day moving average, at the median line, a stop against that high would be pretty tight to try to play the last extension. That would be an opportunity. Or if we see the spill continue, possible exhaustion and a rebound play here. Again, take out everything. Take out the 50% retracement. Take out parallel support. Just put your cursor there. Former swing lows, former swing highs, former swing highs. It's a pivot in price, plain and simple. Okay, so that's kind of where I am on Kiwi. A little frustrating because I wanted to get something on this, but it's either a recovery and another fade opportunity from there, or look for a larger rebound off of 66, 96, 67. Here's what it looks like on the intraday chart. Okay, so what do you do with that? It broke below, kind of sneaked just below that last night in reversal. Again, weekly open resistance, 67.95. If it holds there, great. If you get the other extension higher, we need to see failure. Basically, ahead of that 200-day moving average, that upper parallel. Any questions on Kiwi? I know it's not the cleanest chart. It might be a little cluttered last night, guys, after I added that pitchfork, but objective stuff. It's just that pitchfork kind of reflects some interesting areas that we're looking at anyway. Okay, questions, comments, concerns on Kiwi. Again, the weekly chart, just to put things in perspective, this is why I'm not really interested in tempting the downside, at least on the immediate front. For me, this is a break of the upper parallel. That would be the support hold before resumption. I don't know if it's going to hold. And again, if you get the downside break, you have the levels, but need to look at that. What is the date of the lower slope at 67? On which chart, Ty? Daily? It's the 50% retracement of the advance off the lows. What's the date of the lower slope? So if you're talking about the pitchfork off the low, you're talking about the low from September 11th and the subsequent low that we made on October 7th. So September 11th low, September 21st high, and October 7th low. Right here. Does that help, Ty? All right, he says yes. Okay, so Kiwi requires a little more patience at this point. Interestingly enough, Euro Kiwi number 4. This one was just ridiculous. Here's Euro Key. So if you remember, I posted a chart of this early in the week, but I didn't even put a scalp because I didn't really know how I wanted to attack it. Here was the post from the 16th. The only thing that mattered was this daily chart. We were coming into confluence resistance. The region of focus was 67.30 into 67.58. We stretched into that region. We cited a long bias above 65.21. What was 65.21? That was the initial yearly opening range lows from January. Okay, and basic channel support off the lows. So if this thing was going to pull back, that's what needed to hold the support. Guess what? We marked a low at 65.31. Okay, literally 10 pips off before it turns, or 32. And then we broke to the upside, right? We broke right through the ascending channel. So last night I wanted to highlight that breakout. The big level in focus was the yearly open, the 38.2 retracement of the decline, and the 1618 extension gave you a range of 69.08 into 69.66. I know it was a big range, guys, a little over 50 pips, but Euro Kiwi. You got to give respect where respect is due. Guess what? We bounced and highlighted or rebounded, rejected, reached, stretched, whatever you want to call it, right into that region. Okay, there it is. Really sweet move last night. Again, I'm not going to art on you. I didn't have a position on this, unfortunately, but if you got the breakout trade, man, that was a perfect target. On this move lower now becomes the test on whether this breakout of the multi-month, multi-year trendline resistance is going to be legit or not. Initial support looked for like 67.58 if it gets a deeper pullback, but this is the major resistance hurdle we need to clear to suggest that a more important low is in place, and I think we're going to get it. Okay, so if you're holding any long exposures, if you tried to play the breakout, that's the first level. I would be booking profits here. I'd be taking my stops to break even or better. If this slope holds as resistance, carry on. Next topside break gets you 71.30. But from here, certainly you do want to reduce your exposure a little bit on this. Objectively, this is a breach of the December opening range highs. Objectively, this is also, well, we're not there quite, but we're going to be approaching the November opens level. So it looks good. Okay, it looks good. It's just at this point you're coming off near-term resistance. So let it set back a little bit on an initial stretch lower. Something you just typically want to kind of just tack on real quick is a retracement, and look where the 618 comes in. So even if this thing were to spill all the way back to test trendline resistance as support, it'd still be constructive, right? Ideal scenario, you get a 38.2 bounce, which will converge or hit right on there with the former highs from last week. Let's drop that 100. That's kind of what I'd be looking for. Ideal scenario for support, bearish or bullish rather, invalidation. Topside pop, you're looking for 71.30. Now, again, on something like this, where you get a breakout of a multi-month trend line break or something, I want to see some structure to the advance. There's no forks that really help. The only channel that we were watching has given out, so that might be support. But once we get a little bit more back and forth on, I think this looks pretty good. What do you mean by 1220 DXY, Mike? Ty? Is that a typo? All right. Any questions on Euro Key? He said I was labeling my chart. No worries, typo. It's all good, man. So that is Euro Key, a very interesting cross. We don't talk about too much, and while we brought the attention to it early in the week, last night or yesterday's breakout I think was telling. So we need to look higher there. That's number 4. Number 5, dollar CAD. Is it even worth looking at? Oh man, this thing just won't budge one way or another. Dollar strength, dollar weakness, doesn't even matter. It just doesn't want to do anything except just slowly crawl higher. Here's dollar CAD on the weekly charts. This is why I've been unable to do anything on dollar CAD this week, at least anything with conviction, try to put on a position here. Last year's open, 34.35. We talked about that region. 50% retracement of the 2015 decline. We talked about that region, or 2016 decline. 33.75. It was the highs back here in June. It was the highs again for the December opening range. Here we are again. You're getting a weekly push. No stretch, no acceleration. I have no clue what to do with it. So all I know is the next major key level to the upside is 36.45 into 36.85. That's your big next major region. It's last year's high week close. It's the 1618 extension off of last year's low. It's the 618 retracement off the 2016 high. This is your next major region. I got nothing to do in dollar CAD unless one of two things happens. It stretches into here and we look for failure. Or if this week's close materializes below 33.75, that would be screaming failure for me. Exhaustion. And I'd be looking to play the downside targeting this region here. Aside from one of those two things happening, guys, this is just, it's going to sucker in so many people. It's going to sucker in so many people. I'm not going to get involved with it. So, if this break is legit above this resistance region we've been watching, I want to see acceleration to the close of the week. The level to the upside. If we fail 33.75 on a weekly close basis, look for the exhaustion play. That's the gist of dollar CAD into the end of the year. Okay. Now, intraday and daily, let's look at the daily chart real quick. It's not all that ugly. It's just from a trading standpoint, how do you attack it? Okay. 35.35, just a pivot in price here we've been watching. You have the upper parallel for basic channel resistance. All of these slopes that you see here, guys, are derived just off of these two levels. Boom, boom. Once we broke, we took a parallel off that low. Looks like it caught pretty clean here. Extending off those highs, boom, boom, boom. Still the same zone. Here's the 2017 open as support, first area of resistance, 34.35. Intraday, not much sexier. Same channel, chop central, divergence into the highs, right? Price action with a higher high on a closed basis. The oscillator with a lower high. But, it's done this before. We've been here before. We've seen this story. I've played it a million times, and every time we get short, we take a quarter off, and then we take a break-even stop, or even take the full stop, because this thing just hasn't been able to find any follow-through on the downside. So again, we're going to stay objective here. I'm not going to get all caught up. If we spike higher again to 35.35 and we see failure, maybe a decent play. I'd rather take it off that key resistance range we talked about. If we get a downside break of the slope, I want to see at least last Friday's low break. Okay, and then we'll start playing the downside. Till that happens, guys, this is kind of a wait and see trade. Questions on dollar CAD? All right. That is number 5. Number 6, Aussie. So for Aussie dollar, the previous update, here's what the sort of game plan was right ahead of the FOMC. If Aussie was going to fail, 71.60, you guys all know that's the level I was looking at. If he tried taking long off that earlier in the week, he got some decent play, but it couldn't make any type of progress or even attempt to make a run at that 100-day moving average. So the emphasis for me was all higher above 71.60. Once that gave out, that was our bullish inval. Okay, you had the 618 retracement of the advance. You had just a decent pivot in price from the former swing highs that we made back here on the October open. You had the lower median line parallel for the pitchfork off the yearly lows. That needed to hold yesterday, and it didn't. Okay, and it didn't. You might see some more upside here today, 71.60. Even the underbelly of that pitchfork, I wouldn't rule out, but it's still a break of support. Okay, so unless price resolves and makes a weekly close back within the confines of this pitchfork, guys, Aussie broke. Now, the reason I'm a little concerned on getting too happy or excited about playing an aggressive short is just because of where we rebounded. Yearly low day close, 70.86. You guys have heard me talk about that level. That was sort of the big level that we talked about if we break the pitchfork. Man, it made quick progress, right? A couple hours after FOMC, we were already there. Here's the rebound. A pretty strong reaction off of a pretty important technical level. Again, the yearly low day close. So again, I want to kind of sit this out and see, how it pans into the I guess to the yearly close. If it fails at 71.60s, again that upper parallel, I think the downside play is intact. Playing 70.86 again would be your first target. Yearly low comes in here, 70.21, but it doesn't jive with what I'm looking for on the DXY, and that's why I'm a little hesitant to get too involved. The pending trade that Jamie had was it's a decent stop, right? It's not that big of a stop for the swing, so it might be worth a shot, but watch that pitchfork. It needs to hold his resistance. It needs to hold his resistance. I know that the 50 line on the upper side didn't give us quite clean resistance, but look at this line: support, support, break, acceleration, resistance, resistance, halt, rebound, break, acceleration. That needs to hold his resistance if we're moving lower. If this thing recovers back up through, could be a false break scenario. So I'm a little hesitant to get aggressive on this one. Here's again Aussie on the intraday, and to keep you in mind on where we are in the larger scheme of things. Here's Aussie on the weekly charts. Low week close is also 70.86. No surprise there. Look where we rebounded. So if you go to the previous update, remember weekly and daily charts for my strategy are always one click away. Here's the weekly chart. There's that low week close, 70.86. There it is. All right, so Aussie and Kiwi, both in that camp of which, Kiwi I do want to see lower. Aussie, if it's going to fail and move lower, it needs to see failure, sort of 71.60s, 71.80s max on this stretch. That 236 comes in the same area anyway. Not bad. Questions on Aussie dollar post FOMC. Okay. What's next? Yen crosses. Who's involved with these things? They're all super interesting this week. I guess let's start with Kiwi Yen first. So here was the Kiwi Yen setup earlier in the week. We had come off a huge resistance region, doubled back. The big area of interest was 76.40 into 76.33. That was the first target for the downside break. But if we saw a pivot break below that, your next level is 75.55, 75.62. So this thing, well, I just show it to you. It's kept on holding this decline really clean. Okay, there was the hover. You failed again at 77.30's resistance to start off the week. The break lower yesterday. There was the initial target, 76.33, 76.40. We sailed right through it. look where we rebounded last night. Lower median line parallel, 50% retracement of the advance, former swing pivot low from back here in April, all converged right here. Now, momentum isn't oversold, so I wouldn't try to buy this, but the yen strength story has been paying out, guys, on every single pair except the dollar. Kiwi yen, Aussie yen, Euro yen, maybe not as much. Obviously, that's sitting at support. I actually like Euro yen higher, but we'll look at that in a moment. But for Kiwi yen, picture perfect. Picture perfect. We just dropped right into this pocket right here. So near-term resistance, right back at that firmer support target that we were looking at. Bring that down right down to 76.40. That's the breakout that would suggest that you have to play resumption of the pitchfork. But as it stands right now, you are at support. You are at support. Okay, so it looks like this commentary came right before the webinar, it looks like, but we did reach an agreement here in the US, guys, as far as budget. So this whole thing about a government shutdown seems to be hitting the wires as something that's sort of been curtailed, at least now, concerns about that. And no surprise, I guess let's just take a quick look at SPX on that news, that we should be seeing some support. So remember, guys, the SPX, I'm going to take a quick segue here. We haven't, that's number 7, SPX would be number 8. Do you remember this chart? We were talking about this earlier in the week. Log scale of the basic SPX. This is just from the lows that we made back in 2009, right? We talked about two things. A, the median line was right here. B, you had 100% extension off the high, so 2 equal legs down if it's correctionary. A 38.2 of the 2016 ascent gave you 24.75, 25.08. That's exactly where we bottomed so far. So maybe this government shutdown aversion may offer some support, but at the end of the day, guys, we've broken the yearly opening range lows towards the end of the year. It doesn't bode well for equities. And this is the German DAX, by the way. Also a trade that we looked at briefly this week. This is the level that we looked at last week in the webinar on the in daily effects at 618. Finally got tagged this week. 10,569 is the 618 retracement of the entire 2016 advance. It also converges on multi-year slope support. So your 2003 lows, your post-crisis 2009 lows. Sure, we dribbled below it a little bit here, but there's that lower parallel converging on 618 and slope support. If you take basic channel resistance, extend it to that high that we made in that bounce in February, resistance, break, acceleration, all converge right here. So, keep in mind one thing. The DAX has actually been one of those equity markets that have been leading, guys. This is why we look at this stuff. I'm not trading DAX. I'm not getting involved in, futures on that side, but it is a tell. It is a tell. And if you look at the SPX, that's just basically caught up these last couple of months as far as the magnitude. I mean, look at, I try to keep things as objective as possible. I don't want to digress, but look when we broke the yearly lows here, guys. We broke the yearly lows back in October in the DAX. SPX just broke the yearly lows this week, right? That's what I mean by this is just catching up. So equities at support, right? SPX at objective and identifiable Fibonacci support. DAX 30, JUR 30, dirty 30, we call it, at objective support. All right. Any questions on those equities? I digress a little bit. Jamie had an incredible Euro Yen stuff. What do you have? So Ty, I have Euro Yen. Literally every time I write about this, man, I think of you because you're very you love the Euro Yen pair, and I do too. When there's clear breakout potential, when there's clear directional bias, this year for me, Euro Yen has been an absolute disaster. I haven't even touched it. I don't even think I had one position on this, maybe a couple of scalps, but look at this. I was looking for clearance this week. We didn't get it. And like I said, all the euro crosses, or the yen crosses rather, aside from the dollar, looked pretty good. Kiwi yen, Aussie yen. Euro yen was something that we had highlighted, but we needed either a break below 27.60 or a breach above basic slope resistance to go for a move on 130.40. Man, it hasn't done jack. It hasn't done jack. This is the weekly chart. I could go over this a million times. It's going to look exactly the same every week, which is what frustrates me a little bit, Ty. But here's euro yen, man. Here's what it looked like. This is on the 16th as we were starting the week, right? Looks like an identical chart to me. Ain't a damn thing changed, right? You have the the 200 week moving average converging on the yearly low week close. That, my friend, converges on basic slope, a parallel of the lows that we made from here. Parallel here, you saw resistance, resistance break, acceleration, support, acceleration on both sides, support, dipped below, but on a closed basis, support, support. It's all right here. It's all right here. So look, if you put a pistol to my head, I think it does break lower first, the way that it's reacting towards this slope. But it's a consolidation, Ty. Anything you do inside this consolidation until it breaks needs to be just a near-term position. Plain and simple. Here's the daily chart on euro yen. Right? Whoops. Right? Here it goes. If you take just basic trendline support from last year's low and this year's low, boom, that's there. The October low day close, that's there. We already talked about the low week close at 27.60. Low day close comes in at 27.57. You know what I mean? The levels are super clean. Now, Ty, take everything I just told you and throw it right out the window. Low day close, weekly low day close, trendline support. Take it all that, throw it out the window. Objectively, here's your monthly open, and here's your monthly opening range. Like every time I try to break this down into something, it keeps pointing to the fact that we have not broken a consolidation range yet. You know, people were looking at this slope. You know, this is kind of the consensus. This is probably why you don't want to really follow Twitter too much. The people were watching this slope, then it broke. Then they watch this slope and it's still inside. And they'll readjust the levels a million times. At the end of the day, laterally and objectively. Oh, sorry about that. It's a monthly opening range. Monthly opening range highs comes in right along with the 100-day moving average, a basic 38.2 retracement of the decline. And in case that wasn't enough, the monthly open is right here at 129. So, man, there's nothing I can do until we break this range, Ty. He says, are you a buyer at 127.57? Yeah, I mean, if I had to take this on an intraday scalp, I don't have any positions on this, just for the record, Ty. Your stop would be against those swing lows, yeah, and your entries would be every time you tag 27.57. That's just not my ball game, though, because I've favored yen strength, as you've known, versus the Kiwi, versus Aussie. So, you know, I'm not going to triple up on this, and I've favored euro strength because I'm holding a long euro position. So I don't want to double up on that. So for me, it's kind of a non-touch right now, just based on my positioning. But yeah, if you put a pistol to my head, you want to get long every time you get towards the range lows. I mean, that's not even like a smart thing, you know, a clever thing. Worked here, worked here, worked here, right? It's just until the range breaks, that's the range. Okay, here's the intraday chart. Now, what I wanted to see, and why that question to me, Ty, earlier in the week would have been, hell yeah, I want to buy if it gets to 27.60, is because of this pitchfork. It's too early to tell if it's really in play. We haven't gotten any major inflections. All the interior lines, like the 618, you know, the 75% line, the 25% line, none of them have really offered, you know, major inflections in price. So my point being is I wanted to see this level hold, and that was the idea early in the week, was if it holds that 27.57 level, that's our buy. So you got the drop into 27.57, but the rebound respected downslope resistance. That tells me that there's something concerning here. Okay, and again, Ty, for me, it's not worth it to play in these chop levels, at least in this market, because you're getting breakaways, you're getting reversals, you're getting breakouts, you're getting, Euro, DXY. We looked at all these things that look like they're finally making a move. On this one, since the end of November, I could have seen myself getting chopped up here. So play it with caution. You're getting divergence obviously into the lows, price action making a lower low in price, the oscillator making a higher low. So if it's gonna hold, this is the level, Ty. And with the same respect, if this gives out, it's gonna be an accelerated drop. You should see real quick move down to 2660. It's 100 pips. Big supports at the low day close, and that takes down to like 2550 down here. But until it breaks the range, we're just in the range. Does that make sense, Ty? I know you love yourself some euro yen here. Let me just adjust that 100-day moving average for you. A little bit lower. Ty says, to me, the breakout potential failed yesterday. Lots of movement without range breaks. On which, so you have to stay objective, Ty. On which pairs? I would say on the DXY and the euro, as we discussed earlier, I think this is challenging a breakout. Okay, we don't have confirmation until today's close. Absolutely, you're right with that. But when you're looking at something like euro yen, you haven't even cleared the weekly or the monthly range yet. It hasn't even made an attempted breakout. So for me, I'd rather shift the attention on confirming the breakouts that we are seeing rather than trying to front run a breakout that hasn't materialized yet. Does that make sense? Good questions, though. All good questions. Okay, so euro yen, little bit hairy on euro yen. I'm gonna sit this one out. That's number 8, 9, 10. Number 11, Aussie yen was another one that we were following. This thing just obviously like collapsed. The last level of interest, well, let me say this: the big level of interest we were looking at to start off the week was 80.60. That was the 618 retracement of the advance. That was right below the objective monthly opening range lows. That also had downslope support. That was the level that we were looking at. If it was going to find a bounce, that was the region. If it was going to break and fail, that's where you want to see acceleration. And boy, did we get it. Here's Aussie yen. Okay, here's Aussie yen. So the major level of focus was 80.60. If we get an intra-week or intraday rather spike on a major kind of volatile play in equities, if it caught 80.25, I would have left that as a possibility too. But like I said, when this thing broke 80.60, guys, it plowed through. There was not even a halt. And obviously a very good risk barometer trade typically. The decline just smashed right through. So 79.70 was the next level. The big 100% extension comes down here, basically at 79 flat. Looks like we're turning just ahead of it. If you're holding shorts, I would be inclined to still look for the extension down there. Don't want to get stubborn with it, but I was looking at this earlier before the webinar. I was kind of seeing, is there something that I'm not seeing that maybe caught support here? I just don't see it. So, all things held constant, I would want to see 79 hit here on Aussie yen. Every slope I looked at, we broke. We simply broke. So, when the trade is like this, guys, if you're lucky enough to be in a move like that and you see the accelerated drop, those are the ones that you want to hold on to. Even for an intraday guy, those are the ones you want to hold on to because what do we always say? A downside break of descending slope can oftentimes be the biggest part of the decline. If I'm not on that ride, I don't want to pull out, right? Same respect on the upside. The ascending break or the breach rather of an ascending formation, typically that's the sharpest part of the rally. So if I'm lucky enough to be in a long position and I'm in the breakout, I'm just chipping away at it, right? As we're moving through the targets, maybe taking a little bit off, but we want to kind of hold a core position. So Just my opinion. If you're long or if you're short rather from anything above 80-60, I would just kind of like sit in it, bring your stops down a little bit, break even or better, but I would want to see the extension to 79 here. There are long-term trend line that converge this morning at the euro highs. I love seeing slope breaks that run away to the downside. Math failure, says Ty. So kind of exactly what I was just talking about, right? Yeah, I love to see these slopes when they break descending. Again, I love to see that because that gives us conviction on a lot of things, guys. A, that the confluence region that we had identified is technically significant, and B, that the slope or the gradient that we're following is in fact in play, right? Downside break. It's a 3-point test, so you're already confirming that slope. Here's the drop. Near-term resistance, I would just watch 80-25 as a level, all right? Not a major player, but ultimately sort of the ideal failure point on a rally would be right at that lower parallel, former support, now resistance. Looking for a drop towards 79. All right, that is Aussie yen. Anything else on the FX side, guys? This is our last webinar of the month, so definitely feel free to let me know. As far as the commodities are concerned, here's gold. So on Daily FX, guys, you'll be seeing our projections and our yearly forecasts coming out over the next couple of days. You guys all know where I'm standing on all of these trades. So, gold on the weekly charts couldn't be clearer. We're bullish. We've been bullish. We called bullish invalidation at 1221 this week, which is the December open, heading towards the first target, 1263 on a weekly basis, just higher. You're looking at major resistance heading into next year, and that's near 1270. What's there? Well, it's a 52-week moving average. Basic and objective ascending channel resistance, parallel off that low, which is a 3-point touch, extended off that high, right? The upper median line parallel for the current operative pitchfork off the yearly highs from last year and this year. Saw a pivot break on the upper 75% line. Once we broke, that offered resistance. Yeah, kind of still a little break there into the yearly lows. Pivot break through the median line, that offered support. Pivot break through the upper 50 line, that offered support. It's all lined up right here. It's all lined up right here. Now, longer term, guys, I'm just telling you what's in the report. The broader bullish invalidation for the multi-year uptrend is still down at 1185. I don't think you get that low. But even if things were to spill, and we'll be following this at length all throughout the course of next month and next year, obviously, but that's still the longer-term bullish inval. Ideal scenario or focus objectively. Constructive above the monthly open, that's 1221. Near-term resistance, 1263. Major resistance into 1270. Okay, you got a cluster series there, just right around 1268 into 1270. That's the breakout zone. Okay, gold on the daily chart looks like this. Basic channel support off the yearly lows, basic channel support off the yearly highs, 50% retracement of the yearly range. That's 1262. Basically, that's what we're looking for on this stretch right here. Okay. Now, if things close the day as we are right now, even if we get the spike in 1262, note that you are mounting divergence here. Daily divergence if price action closes at this region. Okay. So, not the time to chase the long side. Let's just put it that way. Okay. It's not the time to get on the long side trying to buy here. If you're not already long, there's nothing to do. If you are holding longs, I would be booking something 1262. If we get that tag today, ultimately, it's constructive. It's a constructive trade. We're going to raise bullish invalidation. Start off the month was down at 1214, 1215. Like I said, we're going to raise that to the monthly open at 1221 now. Intraday. I'll be putting out a chart later on Daily FX that looks like this. Here's the intraday for gold. There's 1262, 1260. There's 1268. Wait a minute. We just said 1268, 1270 is a major region. Guess what? The 1618 extension of the advance off the lows is right there as well. This converges on the near-term upslope from the lows of the year. This pitchfork has been very clean. All of that right around 1270, 1268. So look for failure up here, by the way, guys. Look for failure. Okay. JA says, Happy holidays, Merry Christmas, sir. I couldn't hear anything. I had a power cut problem. Uh-oh, in my area. I'll watch the recording. Okay, JA. Well, if I don't talk to you, have a great Merry Christmas to you as well, and Happy New Year. Ty says, no webinars next week. No, Ty. So, Christmas is on Tuesday. Markets will be in real thin liquidity mode, and yeah, that's not a time I get involved with intraday trading uh, too aggressive. So use the time, enjoy it with your family, guys. Let things peter out. If you're holding positions, not time to jump out per se, but definitely be bringing in your risk and managing that accordingly. Iman says, sorry, Michael, for my early question, but I am continuous follower of your precious weekly, yearly scalp and gold reports from day one. When is expected to have your yearly gold forecast? I think Daily Effects publishes those. There's not much research that's written on the site for Christmas, so they use those as sort of when they release the forecast. So I'm guessing either Christmas Day or 2 or 3 days before the new year, Eman. But you talk to me all the time, so you have all your questions right here. I'm more than happy to follow, to bring it up. Even if I'm out, guys, I'll be traveling with a laptop as I always do. Obviously, we're following markets all the time, so feel free to shoot out anything if you have anything major. But for me, I'm looking for failure at one of these two levels near term to get a larger setback to take part in the long positioning. I don't think there's anything for me on here on the long side to get involved since I'm not already long. So I'm kind of like looking to see if we can't get, maybe a stretch higher into the close of the year, but failure off one of these two levels near term. Make sense? And guys, crude, man, this thing it's do or die. Funny enough, one of my year's trades of the year for the Daily FX forecast is look for a low in gold and crude. And my levels of interest were 43 and 45, 45. Now I submitted that report to Daily FX like a week and a half ago, and we're here already. So look, 45. This literally this needs to hold into the close of the year, guys, right here. And that's just that's just objective slope analysis. Here's the pitchfork we were following from 2015, 2016. The median line was support. Top parallel was resistance. Median line was support. Top parallel breach, accelerated. Once we broke that parallel again as support, accelerated. Here's that same slope, guys. In case that wasn't enough, a key 618 retracement of the entire 2015 advance is right there as well. Okay, the 2017 low week close is 43. So one of these two levels is what I'm looking for ultimate exhaustion on this crude trade. I think it's overdone. Again, we're an oversold on a weekly basis, so that doesn't mean anything. We could stay here oversold for another 2 weeks and see price down at $35. I don't think we'll get there. But if it's going to fail, these are 1, 2 levels that you'll see. In that report, guys, and I'll just give you obviously the tidbits here. I studied the extremes for this decline. And a lot of people were asking, well, how extreme is it? It's pretty freaking extreme. We haven't seen levels of this many consecutive declines, this many monthly rate of changes in years. Here's your rate of change. Here's your consecutive candle count for how many consecutive down days we've gotten in a row. Look at this. This is weekly, by the way. Last time we saw this many consecutive weekly declines was here. Obviously, that means that had way more to go. So right ahead of this move that we saw in the interruption here, I took this out into a monthly chart. You kind of get a perspective of what's going on here. This is the largest monthly decline that we saw last month since the financial crisis. Okay, so yes, this is an epic market sell-off. Last time we saw, again, a decline of this magnitude or bigger for the month of November was back here. That saw just a couple of months of interruption before we saw a larger recovery. Again, right here, we saw a 1 month recovery before continuing lower. So my point being is it's do or die here. The extremes that have been measured both in sentiment, both in positioning, both in consecutive and rates, just the rate of change, does suggest that we should be looking for something early next year. If it's going to happen, one of those two levels are the levels to look at. All right. Any other questions? I know I'm over on time, but I want to use this opportunity again to wish you all a very happy and safe, blessed, and healthy New Year and Christmas, guys. Amen. Says, sorry, Michael. Oh, I already got that one. Merry Christmas to you as well. Happy New Year and God bless you. Ty, same to you, my man. Kamal, same to you. Amen says, God bless you always. Merry Christmas. Wishing you the best of 2019. Hope you have a trip to Jordan, Dubai, or Spain to meet me and all my family members, Michael, as I was always telling you about. So I've hit Dubai not too long ago, Jordan and Spain. Have to add it on the list, man. But thank you so much as well. Michael, same to you, my friend. Same to you and yours as well. Happy holidays to everyone in the room. Thanks again, guys, making SB. This is our 5th year going on now, going on strong. You guys keep these, webinars and the service so exciting and engaging for us that we want to reflect that thank you as well. So Merry Christmas to everyone in the room. Happy New Year, and I will see you on the flip side of 2019. Blessings to everyone. Cheers.